So yesterday we did an easy language lesson on a strategy that we had the idea from CNBC Mike Santoli, and we were listening the other day as we do, and we heard Mike Santoli make a statement, paraphrasing this, that if the VIX closes 3 points below its high, then you buy on the close. And so I just drew this as the high. If it closed down, say for example, this is at 36, if it closed at 33 or lower at the close, then you'd buy it on the close. And so we back tested that, we looked at the results, and they were okay, they were positive, but we talked about how the strategy could be improved. And so this is part 2 of that. And so I'm going to go over the easy language. I've added one rule to make this strategy much more profitable, and that rule is for the VIX to be less than 30. So that's a common rule for taking long trades. When VIX is less than 30, that's kind of a threshold where VIX goes above 30, volatility is high, and there can be a lot of bearish price action. And so we had this all on one line before, and now we've put it on several different lines. And so there's more lines. This was all on one line without this line right here. And so we separated it into different lines, and we added this one rule. The close of data 2 is less than 30. Data 2 is the VIX, $VIX. We're talking about the cash CBOE VIX, not the VIX futures. And then the exit is the same. We looked at a $2,000 profit target, $1,000 stop loss. We're just trading one contract. And so let's take a look at the results, and you'll see how that has improved. So here are the back-tested results. 12,612.50, 78 trades. It really eliminates quite a few trades. A $5,200 drawdown. And here is the equity curve. So a much nicer equity curve. Not a lot of trades. It's a very low frequency strategy because we have the date set back to 2001, but the VIX data is actually doesn't go back until it goes only back to 2003, and so the trades here only go back to 2006, and so that is the improvement. Let's take a look. One of the reasons why I like to separate these, I'm going to go over the easy language. One of the reasons why I like to separate these in lines is you can comment out lines. So if we want to take a look at the original strategy that we talked about in part 1 of this setup, is we would do this right here. We could comment out a single rule by putting in 2 front slashes in front of that line, and so that's why I do that. So let's look at the results. Here are the results going back further. In the first video, we didn't go back as far. So net profitable above the 0 line, but not an upward sloping equity curve from start to finish. So a lot of volatility in this type of trading, and we don't want to just take this type of trade the way it was stated. If the close of the VIX is less than the high of the VIX minus 3 at 1500 Central Standard Time, then we buy this bar on the close. And so easy language lesson, high D is the high of the day since midnight, and so the close at 1500 Central Standard Time, the stock market closes at 3 p.m. Central Standard Time, and we are on exchange time. And then we're looking at data 2, close of data 2 is less than the high D, the high since midnight of data 2 minus 3, then buy this bar on close. And then if the date is greater than the entry date, then we set exit on close. And so we don't get out on the first bar or on the first day. So for example, if in this strategy, get in at the close of the $1,500 bar, 3 o'clock bar. The next bar is 15:15, and you would get in, and if you had set exit on close, it would just get out here at the 1600 bar. It would be only a 1 hour trade, and so we're not looking to do a 1 hour trade. So we wait till the date is greater than the entry date, and the entry date becomes greater than the entry date after midnight on the next day. So it would be it would exit at the close of the next day. And so then we set profit target, set stop loss, and you can put in the number there, and we're just trading one contract, so that's on a per contract basis. And so that is the updated version. Take this out and you have a tradable strategy. So these results are without slippage and commission, but this $161 average trade profit is very high, and this drawdown is acceptable. And so there's a starting point. From this point forward, what you might do is to try to increase the trade frequency of this strategy, or find additional rules or additional ways to take more than 78 trades over since 2006, or a 14-year period. You want to take more than 78 trades. So that's what you would do next in maybe improving this strategy, is to increase the trade frequency.